CrowdStreet, the nation's largest online real estate investing platform, gives investors like you access to institutional quality opportunities across asset class, risk profile, geography, and sponsor experience. Create your own account free of charge and start building your personal real estate portfolio online. From multifamily to self-storage and senior living, choose the deals that meet your own investment criteria. With more than 540 closed deals and over $2.4 billion invested, thousands of investors have discovered how easy it can be to invest in real estate with CrowdStreet. Learn more at crowdstreet.com. That's crowdstreet.com.
I'm John Fort. You're listening to CNBC's Tech Check. Our show is live weekdays at 11 a.m. Eastern. Listen in. Happy Wednesday. Welcome to Tech Check. I'm John Fort with Carl Quintanilla and Deirdre Bosa. Today, tech has an attention span problem. We're going to tell you why historically low short interest is leaving few winners this week. And then Cathie Wood explains her potential new investing strategy, ARK on steroids. Plus, meet the fund manager who's taking the other side of every one of the trades she makes. That's coming up later in the hour. And finally, pop the hood. This stock is having serious trouble. Why shares of Robinhood are down nearly 30% in just the last month, Dee.
Well, we start today's feed with what's become a multi-day sell-off in tech stocks. The NASDAQ lower once again by about 0.25% as yields rise. The stocks hardest hit have been those smaller, high-multiple growth stocks we've been talking about all week. Peloton, CrowdStrike, Okta, down double digits over the last week. ARK Invest Cathie Wood was on Squawk Box earlier this morning, defending her investments and even touting a new strategy she's testing that she says is, quote, like ARK on steroids.
What we would be doing is shorting stocks that are in the big benchmarks. And when we get into a risk-off situation, what happens is portfolio managers and analysts generally run back to those stocks, get closer to their benchmarks, and they dump our stocks, which are either small parts of benchmarks or not in benchmarks. Great opportunity for us, as we have experienced during these last few days, to pick up on those stocks because it's simply a risk-off move to get closer to benchmarks. And by the way, we think the benchmarks are where the big risks are longer term.
She goes on to say that they're where the big risks are because there are value traps, the companies that are being disrupted by the names that she's investing in. Carl, she's doubling down on her thesis and, interestingly, could be using a short strategy to not hedge these sort of high growth bets that she's made, but to amplify them.
Yep, I'm going to try to start with that in-house, John. She said want to try it on ourselves before we let it out into the outside world. But overall, sort of doing what she does best, and that is arguing for a mega investment wave in CapEx and telecom and innovation and sort of looking past whatever cyclical inflationary dynamics we have going on right now.
Yeah, sounds awfully fancy to me. When I look back at previous cycles, the dot-com bust and rebound, and then at the financial crisis and the rebound from that, it seems to me that very little of it was able to be telegraphed based on what hot companies had been doing already and their current hot products. I think very often what we failed to do sort of in the tech media and tech watcher and even tech analyst community was think about, Dee, what are these companies' capabilities? How strong is their leadership? How consistent is their vision? And does that line up with where things are actually headed? So the popular narratives aside, you know, the kind of meme trades aside, what's the actual value of innovation in some of these companies? I think the conversation maybe needs to get back to that.
Yeah, and I mean, she calls out Zoom by name. We had earnings this week, and a lot of Wall Street has turned bearish, but she says she's doubling down, Carl, because this is a unified communications system. It's not just one thing, video chat. It's more than that, and that plays into sort of the themes that we're seeing emerge outside of the pandemic once we get on the other side, which is a hybrid workplace, something that, you know, she's talking a lot about, and maybe some of these deflationary forces like cloud and AI.
Indeed, although the chart right there sort of shows the debate that's in place regarding Zoom, but she does call it an important communications tool and impressed that it has positive comps after last year's incredible year. Let's stick with this week's sell-off in tech stocks, which is continuing today. The NASDAQ underperforming tech and consumer discretionaries are the laggards once again. Bespoke research pointing out that much of the selling is concentrated in the stocks with the highest price to sales multiples. Joining us today, Bespoke Investment Group co-founder Paul Hickey. Paul, it's good to see you. What a week we've got going on. And this overall line of thinking that higher yields are, in fact, bad for long-term growth names. You say, though, history might have a quibble with that.
Yeah, so I mean, I think, first of all, looking at the market this week, we're 2 days into the week, and tech has sold off sharply. But over the last week, tech is performing in line with the S&P 500, even including those 2 days. Look back at last week, tech outperformed the S&P 500 by 2 full percentage points. So there was a big bout of outperformance last week, and I think some of this is coming back, reversion to the mean. Semis were up more than 1%, 6 weeks in a row. In the history of the stocks, that's only happened 5 or 6 other times. So it's been a very big run. But so now getting back to your point about rates and tech stocks, we always hear that when rates go up, it's like kryptonite for the technology sector. But if you look back historically in the post-financial crisis period, what we've seen is that tech stocks have actually done very well during rising rate environments and even outperformed the S&P 500. So there's been about 15 periods where we've seen the yield on the 10-year Treasury rising by 20% or more, and then 15 periods where it's fallen by 15% or more. All 15 of those periods where rates were rising on the 10-year, tech was higher in every one of those periods, 15 out of 15. The S&P was also higher 14 out of 15 times, but overall, tech saw actually a little bit of outperformance versus underperformance.
Right. Not to say that, all right, so we understand that it's possible for tech to rise in that environment, but is it the actual sweet spot? Does that dynamic change?
Well, no, I think what you're seeing is like what we're seeing this week is we've seen a quick spike in rates, and we've seen a fast move. And when you see those fast moves in the initial stages of these legs higher in rates, it causes some dislocations that we see and causes sell-offs. But then overall, you tend to see the sector get back on track. And I think if you're going to start betting against the technology sector here on the premise of higher rates, you're really going against the grain, and you have to have a good reason for why this time is different versus other times.
And Paul, you can talk about tech overall, but there are some very specific trends underlying that have really powered a lot of the best performing stocks during those periods. I wonder if you've gone back and taken a look at what really was important, whether it is mobile wireless 5G, whether it's Web 2.0, and software engineering capability. What caused those companies to outperform that really did during those periods, and what that means for now?
Well, so, I mean, we've seen tech overall, like you said, John, there's a lot of differences within the technology sector, but investors have been rewarding the high growth stocks and the companies that have been showing much stronger sales. And one area where you've seen that, really play out is in the cloud stocks, which have done great. What's really interesting is just getting back to the semis here, we just saw a streak where the sector was up 6 weeks in a row by more than 1%. Going back to the early 90s, you saw that happen a few times in the late 90s, and then after 2000, it only happened one other time up until 2013. And what you see then is the semis have changed a lot over that period. It was an emerging sector in the late 1990s and very volatile. And what you have a sort of parallel now is with the cloud stocks. The cloud stocks are an emerging group. They're very volatile because there's not a lot of profits in the present underlying their businesses. It's more growth and future growth. So I think what you're seeing is this volatility here in the sector. But then again, no sector which has been rewarded investors long term has been without volatility. Just like the semis of the late 90s and into early 2000s were extremely volatile. So too the cloud stocks, you're seeing that volatility today. I mean, just in the last 2 weeks, the sector's down 10%. And in the short history of cloud indices that we have, the cloud ETF was down 10% only 5 other times. And it's a sharp pullback. But normally the investors have gone back in on those declines and bid the stocks higher. So I think you don't want to go all in on any specific sector, but for a diversified portfolio, you want to be looking at these cloud stocks and these strong future growth leaders as a part of your portfolio.
Well, Paul, speaking of volatile, let's talk about the EV space. We see Rivian and Lucid lower again today. It was interesting what Cathie Wood said this morning. She said that she likes Tesla, but not necessarily those two names because they are not autonomous car plays, they're EV plays. Do you think that that's right? That if you're looking for leadership in the car space ultimately, or the vehicle space ultimately, they have to have this autonomous component? Do you think that Lucid and Rivian have that, or Tesla has that over them?
Yeah, so I think she made a great point. And within the EV space, Tesla is a name that we like and that we've owned. And it's a stock that has proven itself to a degree. It's certainly not cheap, but it has proven itself that it can scale up production, that it can build factories. And then the other Rivian, which just came out, I mean, $100 billion market cap within the first few days of being public. You're seeing a little bit more hope as opposed to results there. And when you see a sector that the EV space accounts for 40% of the total market cap of global auto producers, yet it accounts for just 2% of revenues. And most of that is Tesla. So as far as the revenues are concerned. And so I think what you've seen is if we were to pick a name within that group, Tesla is the name that we like better than the others.
Well, one thing we're grateful for this season, Paul, is Bespoke's research. You make our job a lot easier. It's good to see you. Thank you.
Thanks. You too. Happy Thanksgiving, everyone.
Happy Thanksgiving. Meantime, if you're looking for opportunities, mixed feelings from Morgan Stanley on the ad space looking ahead to next year. And again, it is due to Apple's privacy changes. Snap and Pinterest both see their price targets cut this morning, although Morgan Stanley likes them in the long term, reiterating their overweight ratings. Both of those stocks are down double digits since late October. Those Apple changes, of course, a significant headwind for smaller players that don't have as much first-party data as Google and Facebook, Dee.
And still to come, what is happening to Robinhood? Stock is down 60% since it peaked in August, while other brokerages, they're surging. We will break it down after the break. Stay with us.
Gearheads know that some projects need so many parts, it feels like you need a whole storage unit just to store them. That's what eBay Motors' 122 million parts are for. Think of it as your virtual parts garage. They've always got the right fitment at the right prices. Use the eBay Motors app or visit ebaymotors.com. Let's ride.
At Capella University, education is as smart as the world around us. With the FlexPath format, you can take classes at your own pace, set your own deadlines, and even leverage your previous experience to move faster. Now that's smart. Learn more at capella.edu.
Time for a gut check, and today it's Robinhood. The stock is down 20% in the last 5 sessions, 30 over the last month. Our next guest saw this coming. He initiated the stock at underweight in August. It's been straight downhill since then. JP Morgan's Ken Worthington is now with us. Ken, in a way, I'm not surprised either. I mean, they warned about crypto for the second half of the year. The meme stock thing isn't happening anymore. But when you look at Robinhood, where is the value really, and what do they have to prove versus other brokerages?
So what this company has done, and first, good morning, and thank you for having me on. What I think Robinhood has done really well is it's a growth company, right? And it's gathered an awful lot of accounts, about 22.5 million accounts, almost as many accounts as Schwab has. Schwab's been around forever. So Robinhood has done a very good job of growing this account base. The problem is, they don't make any money on this account base yet, and they've got to prove that they can take this large number of clients and actually turn it into a business model that actually generates earnings over time. And if you look at what they did in the third quarter, they actually didn't grow. The revenue per client went down. So they need to reverse that, and those two metrics really have to be growing in the future.
Yeah, I mean, when the market is, heading up and there's money to be made all over the place and people are, chatting about their favorite stocks on the street and crypto, it seems to me like it's easy to pick up clients, relatively speaking, but I wonder how many of those are looky-loos, how many of those are going to stick around when the market dips or dives or is unexciting long-term. The brokerages are a bit more proven there. What does Robinhood have to do to prove that it's a long-term player in that growth segment that you're telling me that they've staked out?
Yeah. So ultimately, they've got to prove that in a bad market, they can still grow. And so the proof will be in the pudding when that environment actually occurs. And it does seem to be inevitable at some point. But if you go back to the tech bubble in the late 90s and what happened then, trading volume was very high in 99. Tech blew up in 2000. Trading volume declined 50% plus a year for 3 years in a row, and took, 7-8 years to recover. And if Robinhood can't make money at, this robust environment we're in, it probably can only go down from there.
Right, but Ken, the whole, bull thesis behind Robinhood is that it's going to be more than just a platform in the long term, right? Every fintech these days wants to be a one-stop shop, and Robinhood is supposed to be cross-selling products, getting its users to do more. How urgently does it need to show that? Have you seen any evidence from them that they're beginning to get their users to do more, think more long term?
So, as you said, there's a lot of companies trying to be that Cash App. And so Robinhood would like to be there as well. But Robinhood has basic services to its brokerage customers that don't yet exist. So it can't even take incoming ACATs for people to transfer stocks into their Robinhood brokerage accounts. So there's an awful lot of investment that they need to make to just do the basics to catch up with their brokerage peers, never mind the investments that they need to make for their aspirations to be that one-stop shop. So eventually they should get there, but they've got a lot of wood to chop in the meantime, and they've got to prioritize.
Yeah, and I was just thinking the other guys are not standing still. I'm looking at a chart of Robinhood versus Schwab for the year. I mean, Schwab's close to their highs for the year, and I wonder how much of a moat Robinhood ever had at this point.
So I think that's the question that investors will increasingly ask themselves. So Robinhood has done an excellent job of attracting this 22.5 million accounts and users, but they only have about $4,000 per account. So from an account basis, Robinhood is big, but from an assets perspective, Schwab is 75 times bigger, has been in business for 50 years, has made the mistakes, has corrected the mistakes. And it's something that Robinhood is really going to have to learn. They've got to catch up to the peers. So, again, a lot of wood to chop for them in the future.
All right, Ken, thanks. Ken Worthington.
Great. Thank you.
Meantime, if you're looking for a different way to invest in the metaverse, it's not all just Meta and Unity and Roblox. We got to highlight a CNBC Pro article that is getting some love online this morning, jumping off a Morgan Stanley note that argues metaverse gaming and NFTs could grow as much as 10% of the total addressable market for luxury goods by 2030. So you want some winners? Well, brands like PVH, Dior, and Farfetch highlighted for their use of VR like virtual store and changing rooms, while Burberry, LVMH, DKNY, and Ralph Lauren, they have been successfully incorporating NFTs already into their products. Morgan Stanley's top pick, though, is Kering, the French luxury goods company behind Gucci, Balenciaga, and others, pointing to Gucci's Aria NFT selling for $25,000 last spring, and Balenciaga's Afterworld collection that used a video game to debut its autumn collection. Read more on cnbc.com/pro. Carl, I'm expecting big things from you, from your avatar, maybe some luxury sneakers in the future.
Yeah, we'll get to work on that, Dee. In the meantime, some exclusive reporting from us on Google is coming up. Hundreds of employees sign a manifesto opposing the company's vaccine mandate. We're going to get that story after this quick break.
It takes a lot of ingredients to fix or build a car, like cooking, but without the frozen dinner easy way out. eBay Motors has 122 million parts. It's always the right fitment, so you can follow any recipe to a T. Whether it's a vintage Italian coupe that's classic like grandma's meatballs, or a German luxury car that's as complicated as Oma's rouladen, to cook up something great in the garage, use the eBay Motors app or visit ebaymotors.com. Let's ride.
At Capella University, education is as smart as the world around us. With the FlexPath format, you can take classes at your own pace, set your own deadlines, and even leverage your previous experience to move faster. Now that's smart. Learn more at capella.edu.
Tech stocks are lower once again today. This week's tech sell-off would normally have been a time for some hedge funds and investors to shine if they were short. The only problem is that short interest is at all-time lows. Our Leslie Picker has more on that market dynamic. Hi, Leslie.
Hey, Carl, that's right. Amid the recent sell-off, very few investors are actually capitalizing on the other side of the trade. That's because short sellers are hard to find these days. Short interest for the typical stock is at a near two-decade low, with the median S&P 500 short interest as a percentage of market cap around 1.6%, levels reached in 2021, but previously not seen since the dot-com era. While it's a missed opportunity for hedge funds, which are experiencing unprecedented underperformance already relative to the S&P this year, the shorts shakeout has a main culprit, according to Goldman Sachs. It's retail investors. The firm says their basket of the most concentrated short position trades in correlation to the rise in retail activity. In other words, when retail is more active, as they've been in recent weeks, that basket jumps, causing losses for hedge funds short those names. That, of course, makes them less inclined to go short in general, and therefore they miss out when the market trades lower, as it has done over the last week or so. So for those who still felt compelled to go short, this week did create a few winners for them. The top names in the concentrated short basket include Beyond Meat and Workhorse Group, which both slumped over the last week. You can see there Beyond down about 6%, Workhorse down almost 12%. Hedge funds have been feeling the pain on the long side too, though. During Q3, hedge funds actually lifted their exposure to high multiple growth stocks to reach a new record high. Of course, many of those are still unprofitable and feeling the brunt of the sell-off this week, guys.
Leslie, brace yourself. I'm about to ask a really weird question, which is sometimes I'm going to compare this shortage of shorts to what happens in ecosystems sometimes. People get upset at beavers, right, for building dams in places that they don't want. But if you get rid of beavers, you can often cause a whole ripple effect in an ecosystem that sets it off balance and creates dangerous effects. Are we perhaps seeing a beaver effect in short sellers?
Leave it to the beavers. I do love that analogy, John. And you bring up a really, really good point, because obviously the presence of short interest has been a boon for the retail investors who've been able to benefit from the short squeezes, especially those that took place earlier this year. They continue to look for others, which of course has led to many hedge funds staying on the sidelines when it comes to short sellers, because they don't want to be victim to this. Now, when you look at a chart like the one we showed you at the beginning of this hit, showing the lowest amount of short interest compared to the dot-com era, it does kind of bring up some analogies. And people say, history doesn't repeat itself, it rhymes. Well, is that a sign that perhaps people are either too bullish about the market, too bullish about where valuations are? Of course, hedge funds increasing their exposure to stocks with a multiple above 10 times EBITDA, or is it a sign that there's this kind of other dynamic going on with retail that really says nothing about what's going on with regard to the market as a whole? I think those are the types of questions we're going to be asking as we try and kind of dissect what's going on right now.
Yeah, questions we've asked and will continue to ask. The beaver effect, I think that's a new technical term. Leslie, thank you very much. Staying with that short selling theme, an asset manager recently introduced a way to short Cathie Wood called the Total Capital Short Innovation ETF, SARK. Here is Wood this morning defending her approach amid the broader sell-off.
We believe that innovation, truly disruptive innovation, is priced in the global marketplace, public markets, at roughly somewhere between $10 and $15 trillion. In 10 years, we believe that number will be 200 trillion. So it will go from a little more than 10% of global equity market caps to what we believe could be more than half. That's how much disruption is evolving thanks to DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, all of which are converging so that S-curves will be feeding S-curves. We are on the threshold of the most innovative period in history, bar none. You have to go back to early 1900s, telephone, electricity, and automobile to see anything like it.
Yeah, that fourth industrial revolution she so often talks about. ARK funds, though, they are down sharply the last few sessions, which has been good news for anyone on the other side of that trade. The short ARK fund launched just 2 weeks ago, and it is up about 15%. Joining us now, the creator of that fund, Tuttle Capital CEO Matthew Tuttle. Matthew, great to have you this morning. Quite the start for your fund. And what's, I wonder, been the response so far to the ETF in terms of interest and perhaps blowback from the Wall Street Bets Aunt Kathy crowd, if any?
Yeah, so I mean, the interest has been extremely mixed. Obviously, ARK has a lot of raving fans, and some of them have reached out to me on Twitter, and had some comments that obviously I can't repeat. But we've also seen the other side as well. Whenever you're making highly concentrated bets, you're more transparent than you need to be, and you're making bold predictions, you're going to have your critics on the other side. And some of them have reached out to Twitter and maybe been a little bit nicer.
Okay. Doesn't surprise me, I suppose. Perhaps the side that you've gotten some nicer comments, Matthew. But this isn't just a vehicle for detractors to, as you say, push a button and express their opinion. There's other sort of really practical uses, especially in a market environment as we are this week when we do see some of these high growth momentum names selling off, right, as a hedge.
Oh, yeah. I mean, and that's why we initially launched the fund. It is a great hedge. I mean, you see what's kind of happened this month, and you sit back and you think, well, the S&P and the NASDAQ must be down, and they're not. And so, anyone who might be using an inverse S&P or an inverse NASDAQ ETF to try to hedge is going to be really disappointed. This, in our mind, is a much better hedge. These high multiple names, when the market sells off, they go down a lot more. So that's really the biggest use here.
Matthew, I wonder, I mean, I know you said sort of the response has been mixed, but for those who are interested in the product, is it because they doubt sort of the long-term innovation dynamic she's discussing? Or maybe they believe it, but they feel that these short-term inflationary effects are going to more than offset it?
I think it's all of the above. I mean, you've certainly got the critics who this gives them an easy package to express a view. But then you've also got people who are looking at the environment. We're in a rising interest rate environment. You cannot argue, I don't think, that inflation's transitory anymore, which means that interest rates could rise quicker than we think. And we know these types of companies don't do well. We're also staring at, what could be a correction that's long overdue, and something like this will do a whole lot better than the other hedges out there. So, yeah, there's a lot of reasons why people are using this.
So, Matthew, overall, we were just talking about the relative shortage of shorts in this market. Given the market environment that you just laid out, is that dangerous? Is that going to lead to potentially more volatility because there's not as much downward pressure, perhaps, on some of these stocks ahead of some big shock as there should be?
I mean, it definitely could become a self-fulfilling prophecy. And these stocks in and of themselves are already volatile enough. I mean, look at Zoom Video yesterday, look at Zillow last week. They don't need any more rocket fuel to be volatile. But yeah, that could definitely be the case.
Matthew, thanks so much for being with us and sharing your insights this morning. We'll talk to you again soon. Matthew Tuttle.
Thank you.
It's time for a news update this morning. Let's get to Rahel Solomon. Hi, Rahel.
Hi, Carl. Here's what's happening this morning. Weekly jobless claims tumbling to just 199,000. That is not only the lowest level of the pandemic, it's also the fewest weekly claims since 1969. The sharp decline, another sign of the strength of the U.S. job market. Consumer spending jumping 1.3% in October, topping estimates and doubling the increase in September. Consumer income growth is also well above estimates. Now, at the same time, new home sales were essentially unchanged from September, even as housing prices continue to climb. Deere says that margins will fall by just 1 percentage point due to the month-long strike by union workers and supply chain issues. Deere shares adding to early gains during the earnings conference call. Deere also predicting that farm equipment demand next year will exceed the industry's ability to produce it. And Nordstrom and Gap extending their losses on disappointing quarterly results, both stocks down more than 22%. The retailer is warning of supply chain issues and rising costs. Nordstrom is on track for its worst one-day loss ever. You're now up to date. John, I'll send back to you.
Rahel, thank you. Now, two earnings movers to watch this morning, and boy, are they moving. Strong demand for personal computers and printers, powering shares of HP Inc. higher by about 9.5%, while a positive revenue outlook is taking Pure Storage to all-time highs, up 13% plus. More of today's tech opportunities after the break. Tech Check is back in 2. Rivian shares lost some juice this week, now a third off their highs, but there are still some hedge funds that are seeing massive gains from their pre-IPO investments. Sources telling the Financial Times that Dan Loeb's Third Point made more than $300 million off the debut through a series of investments over the past year, like convertible notes. A number of other funds participated in those rounds as well. Shares are still up more than 50%, though, since that IPO, Dee.
Some exclusive reporting on Google from CNBC's Jennifer Elias this morning as hundreds of employees sign a manifesto pushing back on the company's vaccine policy. Jennifer is now with us. Good morning. Now, a couple hundred employees, yes, it is a very small percentage of Google's total workforce. But Jennifer, we've certainly seen in the past that a small vocal group at the company has had success in seeing outsized impacts in the past.
Right, absolutely. And I'll point out that it's about 600 employees that are signed on right now. That is up from 100 employees in August. So you've sort of seen like a fivefold in employees signing this manifesto against the company's vaccine mandate in the span of 3 months, 2 months. So you're kind of seeing it grow. And yes, as you mentioned, Google has a history of, very outspoken employees, much more so than other tech companies. And they've been able to get things changed. Do I expect that this will actually overturn Google's vaccine mandate? I don't think so. But, there's a contingent, as small as it is at this point, that does not want to get vaccinated. And, in this tight labor market, it poses a challenge for executives.
Right. That's a good point in this tight labor market. And Jennifer, also speak about this sort of latest in terms of Google's changing culture, which you've reported so well on over the last few years. The company started Don't Be Evil, encouraging tons of employee feedback, but that has actually turned into a bit of an issue for the company.
Right. The company has always had this very open discussion, open channel, conversational culture, and that's sort of changed a little bit over the last couple of years. You see the executives kind of trying to rein that in a little bit. You've seen the company kind of change its mission a little bit from, Don't Be Evil to organizing the world's information. And it's definitely a shift in the company. And part of that, too, is just a shift in how the company is approaching business. It's always been this, talent attractor and this company that is a fun search company. And it's really turned into more of like a traditional corporation that is, very much focused on, cloud deals, big government deals, and, things that just weren't always part of the company's past and history.
Yeah. Well, Jennifer, thanks for bringing that story. Great scoop. We'll talk to you again soon. Jennifer Elias from CNBC.com.
Thanks, Steve.
By the way, the exclusive scoop lives on CNBC.com, and Tech Check is back in a minute. A lot of movers today, but let's get a gut check on Autodesk. Worst performer in the NASDAQ. Shares plunging despite that beat on earnings and revenue. It's the outlook that's weighing on the stock today. They lower guidance and billings, or guidance for billings and free cash flow. Analysts react to the report today. Stifel cuts the target to 310, down from 365, says shares are in the penalty box until investors have a better sense of progress. Atlantic cuts to 280, citing concern around supply chain disruptions. Shares of Autodesk are lower now for the year. Company does have a market north of $55 billion. Dee?
Grammarly, the software company that checks and corrects grammar, is now the 10th most valuable startup in the U.S. It is valued now at $13 billion, increasing over fivefold from its last round in 2019. I caught up with CEO Brad Hoover in a Tech Check live stream, and I asked him about how the company's technology, which is a system of AI and natural language processing, can ultimately compete with tech giants like Google and Microsoft. Have a listen.
We want to make sure that is available everywhere people communicate and connect. And we do that through our various integrations. Instead of being constrained to a certain walled garden or suite or OS, for instance, our users can benefit from Grammarly and get that personalized, high quality, consistent experience everywhere they write and communicate. And that's all on a solid foundation of privacy and security. We align our business model with our end users. We have a very intimate application. And so we're only paid by our end users.
You can check out that full interview on Tech Check's social channels and CNBC's YouTube. Guys, walled garden, where have we heard that before, John? This is a phrase that we hear from some of the incumbents when they talk about, facing antitrust issues against the giants like Microsoft, Google, Apple.
True, and I was going to go in a different direction. I thought grammar was dead online. People weren't using complete sentences, emojis had taken over language. But another way of looking at this, I suppose, is that it's like a different type of filter. We know how popular those were for the rise of Snapchat, making yourself look different in videos and in photos. How about making, Carl, your words look different, your grammar look different, effective communication, so important.
John, as long as we don't have to diagram sentences, I'm all for it.
Oh, come on. You worked at the Wall Street Journal. All right, we mentioned HP and Pure Storage. Watch Dell and VMware as well. Both of those higher on a pair of earnings beats. Upbeat guidance. You can see both of them up more than 3.5%. There's more analysis of those results right now on CNBC.com. More Tech Check in a moment. Welcome back. The WCLD, Wisdom Tree's cloud computing ETF, is in the green today, but it's down 10% in the last week. Software and cloud stocks have been hit especially hard. One cloud name bucking that trend, Nutanix, out with earnings beating expectations, still reporting a loss of nearly $420 million. The stock is moving higher, up about 6.5%, 7%. Joining us to discuss the quarter, CEO Rajiv Ramaswamy. Rajiv, good to see you again. I want to ask you particularly about your reintroduction of guidance here, especially given what we saw from Autodesk and another part of software. Well, what's giving you that confidence to be able to give this visibility at this point?
Yeah, John, great to be with you on the show today. One of the things, as you know, we've been doing is transforming Nutanix to be a subscription company. And at this point, we are far along that journey. Our business is almost all subscription at this point, and we have the stability of the renewals business starting to kick in. So this combined with the solid operational track record that we've built over the last 4 quarters, where we've consistently beat expectations and raised them going forward, gives us the confidence to go give annual guidance to our investors. And that's what we did this quarter. This quarter itself, of course, annual contract value bookings grew 33% year over year. Revenue grew 21%. We're close to free cash flow break even. So generally, the company is performing well, and we felt confident about giving guidance.
Give us some color on what's happening with new customers, new logo growth. That is down a bit year over year. And you gave some explanation for that, but I know some investors are a bit skittish about what that might mean given the past. What does it mean this time?
Yes. First of all, we have over 20,000 plus customers, and we are continuing to grow our customer base. More recently, we focused our efforts on actually building bigger business with newer customers. So our sales force is now focused on getting higher dollar values with customers and focused on, let's call it, bigger. We're moving up market, more into the enterprise. And so that has a natural impact in terms of, you get fewer logos, but you get more dollars per logo. And indeed, that's been the case over the last year that we've seen gradually. Our new logo dollars actually have gone up like 25% for each new logo. So that's a trend that we are continuing. And of course, as we go forward, we'll make sure that we have the appropriate incentives in place to continue driving these new logos because, again, our new and upsell business continues to be a foundation, right, that we keep building that in while we then prosecute the renewal business at a much lower cost point. So that's the lifeblood of a subscription economy. And so we invest both in continuing to build our new and upsell business, as well as making sure we prosecute the renewals.
You do point out that you have a better understanding of what you call potential fluctuations in our average contract term length, down a touch year on year. I mean, is that a sign that companies or clients are more cautious, or what would account for that shorter length of a contract?
No, not at all, actually. So if you look at this quarter, this is our fiscal Q1, it's a strong quarter for federal. And the US federal typically tends to have shorter duration contracts compared to the rest of the business that we have. So we've actually gotten good visibility. So every Q1, contract durations come down a bit, and then they go back up in Q2. So the contract duration was about 3.1 years. They'll probably tickle up maybe to 3.2. It's going to remain in that range as we go forward.
Rajiv, we're going to be talking a lot of cloud and infrastructure-related stuff next week with AWS reInvent happening. And one of the themes likely to be multi-cloud, which is an area where you guys play. What are you seeing as the key points of leverage, points of advantage that are determining whether a customer goes with Nutanix versus any of these other number of multi-cloud players? What are you offering that's particularly working?
Absolutely, John. Great question there. So fundamentally, if you look at what the customers are trying to do, they are operating increasingly in what we call a hybrid multi-cloud world, where their applications, they choose the right cloud for the right applications. They want the flexibility to run their applications wherever it suits them best, whether it be based on cost, whether it be based on business reasons, whether it be based on the specific services offered by a cloud provider. And that includes on-prem, right? Their own on-prem clouds, their edge locations, as well as the public cloud of their choice. Now, Nutanix provides a unique value proposition for our customers in this regard, right? What we do is we provide a single platform, single software stack that they can deploy in a consistent way across any of these locations. We do data really well. We manage manage all forms of data, and that's a key differentiation because customers really need to manage their data everywhere. Mm-hmm. Very simple platform, really consumer-grade simplicity to the enterprise. Complete flexibility and choice. Right. Choice of hypervisor, choice of hardware, choice of cloud, choice of licensing duration and terms. And our customer support is off the charts. Our Net Promoter Score sits at 90.
It's a way of a high-quality way, you would argue, of avoiding vendor lock-in, that bane of so many customers' existence over all kinds of cycles. Rajiv Ramaswamy, CEO of Nutanix, thank you.
Thank you, John.
Meantime, JP Morgan is hungry for some delivery stocks, specifically Deliveroo and Just Eat Takeaway, upgrading both names and forecasting strong growth ahead as they see Deliveroo sales beating expectations and Just Eat Takeaway becoming a takeover target for some or all of its business, with Just Eat shares down 40% since January. Dinner, Carl, would definitely be at a discount.
Yes. Meantime, join us later for a CNBC special tonight. It's Crypto Night in America, a primer on the sometimes messy world of crypto, pushing past the noise, telling you instead where the actual money-making opportunities may be. It's tonight at 6 p.m. Eastern Time, right here on CNBC. We're back in a moment. One more thing, this past year, Reddit's rowdy crowd on the popular Wall Street Bets forum became a household name after rallying around video game retailer GameStop, sending the stock soaring in that epic run. Whether you think that's good or bad, it's undeniable social media coupled with the unprecedented access to the market via mobile apps has given rise to a new generation of online traders.
I'm looking at the Wall Street Bets forum on Reddit.
When you say Reddit, a lot of people think Wall Street Bets.
Wall Street Bets, the red hot Reddit. That's REDTIT.
There's no need to spell it out. The Reddit effect is real, and it's shaking up traditional financial markets and lowering barriers of entry for individual investors.
It's nothing short of remarkable.
The forum was founded in 2012, but went mainstream during the pandemic in January 2021. When users, spurred by Redditors like retail investor Keith Gill, better known by his online moniker Roaring Kitty, rallied around GameStop and executed a short squeeze.
I'm not a cat. I am not an institutional investor.
Leading to a wild rise in the shares of the slumping brick-and-mortar video game retailer, once on the brink of bankruptcy.
GameStop shares
There's nothing normal about what you're seeing when it comes to this stock right now.
Since then, subredditors armed with accessible stock trading platforms like Robinhood and Ameritrade have championed several money-losing companies like AMC, Bed Bath & Beyond, and BlackBerry, while targeting hedge fund takedowns and short sellers in the process. But the volatile trading frenzies have led to congressional hearings around regulation and potential gamification of the markets, as well as the evolving role of technology and social media. The whole piece on our Twitter page at CNBC Tech Check. Guys, have a great Thanksgiving.
You've been listening to CNBC's Tech Check. You can always catch us live weekdays at 11 a.m. Eastern.
At Capella University, you're in control of your education. With the game-changing FlexPath format, you can set your own deadlines and move at your own pace. The faster you move, the more you save. Visit capella.edu to learn more.